Hello, in this video we will be going over inventory errors and how to account for them. So inventory errors happen, time to time. We're all human, so it's very possible that an error is made. And it could be an overstatement or understatement of your ending inventory. That could happen by, if there's a physical count mistake or a pricing mistake or just an overall accounting calculation, the software mistake or Excel mistake, anything. And there could be a mistake also in recording the purchases, right? And many mistakes can happen. So when that happens, the question is, how do we treat them? How do we account for them? So we look at the error types. If an error was made in the same accounting period, meaning let's just say on March 28th, I recorded ending inventory at 100,000, and then on September 15th, I discovered, oops, that should have been 300,000, right? Then I would just, when I discovered the mistake, the error, I would just reverse this, whatever I recorded this entry, I would reverse it, and then I would just book a new entry. Okay, so if it's in the same accounting period, you just reverse one entry and rebook the correct one. That one's sort of easy. If there's a material error that's discovered in a subsequent accounting period, so let's just say this year I discovered that last year there's a big, the ending inventory is overstated or understated, whatever it is, then the company needs to calculate what that error is, how much it is, and they need to record a journal entry in the books to correct it. The previous year's financial statements would have to be retrospectively restated. And if you don't know what that means, then go look at the video that I made about changes in inventory methods, because I go into a deep dive of what that means. But the prior year financial statements have to be restated, and the way the way it's done is that on the balance sheet, there's 2 years. There's the current year financial statements and the one for the prior year, because balance sheet shows 2 years. And so for the prior year retained earnings amount, you keep it as is, as what it was actually reported, and then you record what's called a prior period adjustment. I'm going to refer to that as PPA, and that's going to be the adjustment to retained earnings to fix the amount of the error. So assuming the error impacted cost of goods sold in the prior year, it would have trickled down and affected retained earnings. We record a prior period adjustment in the beginning balance of the statement of shareholders' equity. And then you also need to include a disclosure note describing the nature of the error and how much it is and how it impacts your financial statements. This slide I think this is a nice visualization of the effects of inventory errors. And if you look at your formula for cost of goods sold, your cost of goods sold is beginning inventory plus net purchases less ending inventory gets you to cost of goods sold. Then your cost of goods sold, right, goes into your net income, because your net income, your income statement, is your revenues minus your cost of goods sold minus other expenses gets you to your net income. So if your cost of goods sold is wrong, your net income is going to be wrong as well. Then your net income flows into your balance sheet and retained earnings, statement of retained earnings, by you have your beginning retained earnings plus your net income minus dividends gives you your ending retained earnings. So if your net income is incorrect, your ending retained earnings is incorrect as well. So one error in whether it's going to be if you have an error in your beginning inventory, in your purchase amount, or your ending inventory, it's going to end up affecting your retained earnings. I do want to quickly also go through the overstatement. So if you have errors, right, and if you have overstatements, I'm going to call it OS, in inventory and purchases. So inventory and purchases increase cost of goods sold. So if you have an overstatement in these areas, then you're going to have an overstatement in your cost of goods sold as well, which an overstatement of cost of goods sold means you have too many expenses, so your net income is understated, and it just trickles down. And the ending inventory, when you look at the formula, it's less, right? It reduces your cost of goods sold. So if you have an overstatement on your ending inventory, that means you have an understatement in your cost of goods sold. It's the inverse. So if you have overstatement here, you're going to have understatement here. If you have an understatement in your ending inventory, the inverse happens and you're going to have an overstatement in your cost of goods sold. So this is actually really important to keep in mind when you are told, oh, this is understated, this is overstated, of how it impacts your cost of goods sold. I really like how this is laid out. I think it's an easier way to remember all of that. Let's go through an example. The Barton Company uses a periodic inventory system. At the end of 2026, a mathematical error caused an $800,000 overstatement of ending inventory, and assume that this error was discovered in the following year, which is 2027. Now, in this problem, when you see U, it means understated. When you see O, it means overstated. So here's 2026. This is where we're going to start. And they have their beginning inventory net purchases was fine. And it tells us that our ending inventory is overstated. Well, we just said in the previous slide, if ending inventory is overstated, that means our cost of goods sold is understated. So that's what this is showing us right here. If ending inventory is overstated, cost of goods sold is understated. Then it takes us into our into our income statement, right? And we have our revenues. If our cost of goods sold is understated, right, that means we have too few expenses, which increases our net income. It means our net income is overstated, and therefore our retained earnings is overstated as well. So you have to adjust that, right? That was discovered in 2027. So in 2027, you would have to, you see this, if our ending inventory is overstated, we have to credit it because we have to reduce it by 800,000. The other side of the entry goes to a debit to retained earnings because right now our retained earnings is overstated and a debit brings it down. So this is what you do when you discover an inventory error in the following year from when it happened. Let's go take another example when error is discovered 2 years after the actual error happened. So the Barton Company uses a periodic inventory system. At the end of 2026, a mathematical error caused an $800,000 overstatement of ending inventory. So exactly the same facts as before. However, the ending inventory for 2027 is correctly determined. And then this error, this overstatement error from 2026 is actually discovered in 2028. So let's see what happened, right? So again, same thing, our ending in 2026, this is what we're looking at right here, 2026. Our ending inventory was overstated, which means our cost of goods sold was understated, which made our net income overstated and our retained earnings overstated. Okay, we went through that. Let's take it now for 2027. If our ending inventory is overstated, our prior year ending inventory is going to be our current year, the following year's beginning inventory, which means the 2027 beginning inventory is overstated. Now remember, in this example, the error was not discovered in 2027, so we just kind of rolled it forward. It tells us that the 2027 ending inventory was correct. So now we have an overstatement of our beginning inventory. If beginning inventory is overstated, our cost of goods sold is overstated. It's the same thing, and we go back to this right here. Because beginning inventory and purchases increase our cost of goods sold, if this is too high, right, if our beginning inventory is overstated, it's too high, it means our cost of goods sold is also too high. So it has the same relationship overstated and understated. So if one is overstated, the other is overstated as well when you look in the beginning inventory and purchases. So, okay, so our beginning inventory is overstated, which means our cost of goods sold is overstated, and that flows into our income statement. Our cost of goods sold in 2027 will be overstated, which means we have too many expenses, right? Because our cost of goods sold isn't a type of an expense. So we have too much expenses, which means our net income is understated. And therefore, because our net income is understated, it automatically just corrects the the retained earnings, because in 2026 our net income was overstated and that flows into our retained earnings. And then in 2027 our net income was understated, which also flows through into the retained earnings. So they cancel each other out, right? It was overstated here, understated here. At the end of the day, our ending retained earnings and at the end of 2027 ends up being correct. So what do you do in 2028? Well, there is nothing to do in 2028. Our ending inventory, we're told, is the correct amount, and our retained earnings ended up being the correct amount too. So there's nothing to adjust. So when you have an error that's discovered years later, whether it's 2 years, 3 years, then the error will self-correct. So although there is no journal entry required in 2028, the error does need to be disclosed in the 2028 financial statements, describing the nature of the error and the impact of its correction on each of the year's net income, right? You have to state that, oh, our net income was overstated in 2026 and understated in 2027. So the reader of the financial knows that. Let's go through an example. Hightower Company uses a periodic inventory system. The beginning inventory on January 2027 was overstated by $49,000. Let's just take that. So beginning of January 2027, your beginning inventory was $49,000 and was overstated, okay? And the question asks, as a result, Hightower's cost of goods sold for 2027 was what? Well, we know if our beginning inventory was overstated, right, for 2027, then our cost of goods sold has the same impact, right? Then our cost of goods sold is going to be overstated by the same amount. So right now we have $49,000 overstatement for cost of goods sold. Then it tells us the beginning was overstated by 49, and the ending inventory on 12/31/2027 was understated by 79. So our ending, right, inventory, our ending inventory was understated by 79,000, and it was understated. We know when our ending inventory is understated, then the cost of goods sold has an inverse error. So that means our cost of goods sold is overstated. So, so now my cost of goods sold is overstated by 49, plus it's overstated for the 79,000 from the end of the ending inventory error. And so the total of that is $128,000 overstatement. So I think it should be B. Yes, it is B.